It was only a couple of years ago that ChargePoint was a more than $10 billion company, as investors thought that the growth in electric vehicles and therefore electric vehicle charging were going to drive this and other charging companies to new heights. But that obviously has not been the case. The stock has dropped over 90%, and there's now existential questions about ChargePoint. The company continues to lose money, and if losses continue at this rate, then the number of options the company has just continues to dwindle. A falling stock price means it's harder to raise money via stock sales or even debt sales because it indicates that companies aren't healthy. So is this a buying opportunity for ChargePoint investors, or is this a reason to run for the hills and just give up on this company? That's what I'm going to dig through today. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. Go to fool.com/ASYM. They'll give you their top 10 stocks to buy right now. I want to use the company's recent earnings report as context for this discussion because I think this really tells where we are in the EV market and especially the EV charging market and where money is being made. And I think that should help outline what the future for ChargePoint looks like. This is just some of the highlights from the report. And I wanted to just start with revenue and gross margins. You see here $116 million worth of revenue in the fourth quarter, given the full year revenue of $507 million. That means that revenue is declining on a sequential basis. We also see that gross margins are in decline, 22%. There was some growth on the subscription side of the business, but I'll get to why that's not necessarily enough to be really excited about the stock. You can see here revenue for the fourth quarter down 24% from a year ago from $152.8 million. Network charging systems revenue was $74 million, down 40% from a year ago. Now, this is where I think investors often get what ChargePoint does a little bit wrong. Network charging systems is a really fancy way to say EV chargers. They're just making hardware and selling the hardware. So that's a vast majority of ChargePoint's revenue. It's just selling hardware. It's not selling subscriptions. It's not selling electricity at public charging stations. It's just selling the hardware itself. Subscription revenue, and which is the other big line item on the income statement, that's the more recurring revenue stream. But most revenue comes from network charging systems. So what this is telling us is that demand for electric vehicle chargers is in decline right now. And that's going to put pressure on margins. It's going to make your operating costs, which you're already operating at which ChargePoint is already losing money on operations, is going to make that even worse. So that's a really concerning number, is that you don't want to see that revenue decline and you want to see margins going up, and the opposite is happening. So that's why these numbers are so poor for the fourth quarter. GAAP net loss was almost $100 million, $94.7 million, and was worse than a year ago at $78.7 million. I want to go down to the income statement and just kind of explain what's going on here, because I mentioned that network charging systems were the company's most important revenue stream. These are going to be read right to left. So a year ago, that was $122.3 million in revenue, now $74 million in revenue. So that's in decline. But what should be more alarming is there's barely any profit. There's less than a 10% gross margin. So if they're selling a charger for, let's say, $1,000, they're making less than $100 in profit to make that charger, gross profit. And then on top of that, you have to pay for your operating expenses. Research and development, sales and marketing, all that kind of stuff. So they're making about $6 million in profit. Well, look at this research and development line, $55.2 million. Sales and marketing, $33.6 million. General and administrative, $26.5 million. The gross margin doesn't even cover one of those operating lines. Now we go to the subscription side of the business. This is much better margins. Now you have $33.5 million in revenue and $20.1 million in costs. So a little over $13 million in gross profit. But again, that's not enough to make up for the really low margins in selling actual chargers. And so if they were intending to do some sort of razor blade model where you sell the razor, the piece of hardware, at basically break even, and then you make it up on the back end with a high margin product like subscriptions, there's just simply not enough scale to be able to do that. And the amount of scale that they would have to bring to the market is just astounding. Operating costs, $115 million. So to get to the point where subscriptions would cover that $115 million in operating costs, that subscription business would have to be almost 10 times bigger than it is today. So that's just not anywhere near where we are with ChargePoint. ChargePoint does have $327 million worth of cash on the balance sheet. So that's fine, but they are burning cash and they do have debt as well. The non-current debt is $283.7 million. So that ultimately is going to have to get paid off. And that's going to also make it more difficult to raise money via debt. So this was kind of the downward spiral that companies end in. But keep this $327 million number in mind when we go to cash flows, because this is where things start to get really hairy for ChargePoint. $328.9 million in cash burned from operations over the past year. So this is about as much money as the company has on the balance sheet. On top of that, you do have cash flows related to capital expenditures, $19 million. Not a huge number, but there is going to be money that's going to need to be spent on things like capital expenditures. So there's really less than a year's worth of cash on the balance sheet. And what I didn't see from ChargePoint was a real acknowledgement that they need to fundamentally change the way that this business is running. They need to change their cost structure. They need to change the margin profile. And I just don't see that kind of urgency either in the trends of the business or in what management is saying. What they did say was platitudes like, looking ahead, we're focused on operational excellence and delivering world-class driver experiences, prioritization of our software platform, and hardware innovations. That's all great, but what they need to do is they need to cut their operating costs by 60, 70, 80%. And that's not what we're seeing from management. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. On top of the weak operating results, I think the strategic position of ChargePoint is just really, really difficult. And this has long been my criticism of ChargePoint is I don't understand how you're going to be a company that sells a commodity product, electricity, through a commodity plug, now moving to the NYSE charger, and have no differentiation from any other charging network. And you're going to build a profitable business on top of that. I mean, that's very possible to do. There are lots of commodity companies that make money, but in the electric vehicle market, we have not seen evidence that any of these charging companies are going to be able to build a charging network profitably. So that's, I think, really the fundamental problem for ChargePoint is that they're selling commodities in a commodity market. And right now, electric vehicle growth is not what it was a couple of years ago. So now the market's starting to pull back. Obviously, orders for chargers are falling as well. So I think ChargePoint's in a really bad position. That cash burn is really problematic, especially with the debt that's on the balance sheet. So this is absolutely a stock that I would stay away from. Don't know where it's going to go in the future, whether it's going to recover somehow or continue the decline that we've seen recently, but not a risk that I would be taking right now. What do you think about ChargePoint? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.